All right, Yield Nerds, episode 177, and I am racing towards episode 200 and the 3 year mark of Yield Nerd. Thank you for watching. Now I see a giant ditch. Yields have crashed in that ditch in front of the stock exchange. Lucky for me, there are sewer pipes funded by municipal bonds that I own that are pumping in yield into that ditch. At least that is how I feel. Also, I happen to have a new algorithm that I'm using that is giving me double the returns of the NASDAQ, and I will share all about it. Up to 489 subscribers. Thank you for your support. As I come up on 3 years, I am racing towards the 20,000 subscriber mark in about 40, 50 years. So excited about that. If you're new to this show, please use the income investing roadmap that organizes this show in chronological order. There are a couple of playlists, some on preferred stocks, some on what I call Yield Super Bowl, which is the pre-tax yield comparison by duration, and one on municipal bonds, which I'm very high on these days. And most importantly, I want you to know that I have no magical powers of prediction, so whatever you hear here, please make sure you do your own homework. Well, let's talk about the market temperature and this yield ditch I keep talking about. That will be the first part of today. And then we'll play Yield Super Bowl, my favorite game that informs my fixed income investment strategy. And I'll tell you the algorithm I've been using that is giving me double the NASDAQ returns rather, at a lower risk. Well, kind of higher risk, I would say. And then I'll tell you what my holdings are. My equity portfolio is absolutely roaring ahead. And, I have down days too, but when the NASDAQ goes down, my portfolio goes down much less. When it goes up, my portfolio goes up even more. I'm kind of liking what I'm seeing here. And I'll tell you how I did it. And right now, I have around 4%, something like that, in equities, and the rest are in fixed income. And the main change over the last month, month and a half, is that my treasury allocation has dwindled to 55%, and my muni allocation is racing towards the 20% mark. And there are reasons behind it. And my agency bonds are around 12%. So that's kind of my asset allocation. And I'll tell you what I'm doing with my 4% equity allocation as we get deeper there. But first, let's play the Yield Super Bowl. And I'll tell you why I call the current environment the yield ditch. Well, before I proceed any further, I need to warn you and inform you that I am not a wealth management advisor. This is not tax advice, and I don't do politics. I don't have any product to sell. And so let's remind us of what the yield cup was. And I called it a yield cup because it doesn't even look like a curve anymore. And the blue line is March. And we noticed that the curve was disinverting. In May, the bowl or cup formation was a little more pronounced. In August, the middle part of the curve just fell apart, which means you either had to hold the 10-year to get anywhere near a 4% yield, or you had to hold the 3 month. And when we start repeating this process for treasuries only, we get an even worse outcome today. The yield cup is not as obvious here, but it is actually dire straits if you're looking to make fixed income only from treasuries. The gray curve is today, and just in the last 6 months, the entire curve has plummeted. And just in the last month, it has crashed by a huge number. Everywhere along the curve, yields have decreased, and that's pretty astounding. And that means if you're counting on treasuries, you better rethink. The front end collapses, the entire curve digs a ditch. And that's what I keep calling the yield ditch. Are we going to get out of the ditch? How am I planning around this ditch? And I'll tell you all about it and where I am turning for yield in this environment. Well, let's go back to Yield Super Bowl. When we played this in August, we saw that treasuries dominated the beginning part of the curve. Callable agencies, FHLB, FFCB, they offered a decent yield in the middle of the curve, and munis dominated the long end. The challenge with callable agencies is that they are callable. And so the moment interest rates drop, the FFCB and FHLB will say, we don't want to pay you 5%, get out of here. And they will decrease their yields as well. And this is August. Well, get ready for what September brings, and it is a shocker. Just in case you are looking at this going, wait, where are we getting 4.5% and 6%? Please realize that these are pre-tax yields. And so they are pre-tax both for state taxes and some estimated federal taxes. And so you need to plot your own curve. In other words, if you were to buy a treasury at 4% and you lived in a state that had a state tax of 5%, because treasuries are state tax exempt, that is really like owning a 4.2% security. So there's some stuff like that that are woven in. If Yield Super Bowl is new for you, please go back and look at the playlist called Yield Super Bowl so you understand how it is played. I also use the effective tax and not the marginal tax for various reasons. So having said that, here is August 2025 Yield Super Bowl. Let's go to September, and remember the entire curve crashed for the Treasury, so it's not going to be good news for them. Are you ready? Look at this. Munis have taken over the curve. There is literally a small blip of callable agencies at the 2-year mark where they make an appearance. But outside of that, munis are where you ought to be outside of the 3-month. That's astounding to me. And I kind of like what I'm seeing in a different way. So left to me, I would load up on munis, and that is what I've been doing for the last 3 months plus. And I'll show you what that has done to my portfolio and the returns. So here is what adding munis means to me, the way I have been doing it. My T-bills, which are in the very short term, give about 4.2% pre-tax, and they are sales tax exempt. So I would add the Illinois sales tax to it and say, hey, I'm getting more like 4.4%. And agencies, also sales tax exempt as long as you buy FFCB and FHLB, they give 4.5%, 5%, and those are getting rapidly called as interest rates fall. And munis are the kicker. I have several dozen munis at 4.25% coupon, which is completely federally tax exempt. And I own them in the 10-year time frame. I expect them to be called. The previous episode will walk you through why I expect them to be called. And I also own 5% coupon munis on the 20-year side. So my curve, I'm adding duration. That is why you see the tail of the duration go longer. And this has been my strategy, and I'll tell you whether I've been rewarded or not. And here is the answer. All of a sudden, now that the market realizes that rate cuts are around the corner, my returns are going vertical. And so all of my bonds are appreciating. What does it mean for the bond to appreciate? It means that it is hard to find a 5% muni today. And since I own a bunch of 5% munis, instead of trading below par, they are trading above par. And that sounds pretty good to me. You know, in the last month where the markets have been crashing, yields have been falling, my portfolio is actually rising very, very fast, and I'm pretty happy to see that. So let me tell you about my equities and what I've done there. And there is an even more interesting story there. At least I'd like to think it's interesting. You may remember I used two filters to find candidate equities. The reason I still use these filters is I don't want to chase ghosts. I still look for companies with a lot of volume. I don't like heavy debt. I like companies that have a lot of revenue growth. And I look for companies where the stock is growing slower than the revenue. And this way I can argue at least I'm not paying an increasing PE ratio. So when I run those filters, I get a bunch of companies. I used to have a certain algorithm where if I bought the initial tranche and the stock went down, I would not buy another tranche. I would just sit tight, and when it comes up to a price higher than my previous buy, I would buy more. And that all sounded great. You know, I rode the curve on stocks that were going up, up, and up. And when the stock went down, I would immediately stop on the next day. But my aha moment is this is only half the story. Why do I say that? because this informed me when to buy, it did not inform me when to sell. And as I started researching why I was able to get the returns I got, I want to use a case study, and this is my case study. Yours will be your own story to tell. This is Ouster. Ouster makes lidars, and I bought it in May at about 10 bucks and had a lovely, lovely joyride all the way up until 26, 27 bucks. Sold it at an appreciation of 160%. And I did not see this drop coming. I held on to some of it, and I couldn't understand why I didn't see this drop coming. So I never bought following my algorithm. I waited until it went up above my previous trade, which would have pegged it right here. I accumulated more only to see it drop again. And so I was confused. I was trying to figure out, hey, I thought I did this brilliant move, but this little jolt, it threw my algorithm off. So I was trying to figure out, what do I need to do that is easy to manage and enables me to scale across many, many stocks? And here comes a simple twist to the algorithm. And there is a concept called MACD, that is moving average convergence divergence. And it's fancy for what is the long term, and long term here means 26 periods. It could be 26 days. For the day traders, it could be 26 minutes. I don't day trade. I'd like to think I month trade. So it's 26, the past 26 days, what is the trend? The past 12 days, what is the trend? So if a stock is accelerating in the past 12 days and the last 26 days it has not been doing that, then that will have a positive MACD over what is called the signal curve. And the signal curve is the 9-day moving average. And so if the MACD minus the signal, meaning if the last 12 days are accelerating faster than the last 9 days, then you can infer something as an inflection point. And let me illustrate that. This is for Ouster. So the blue line is the MACD line. The yellow line is the signal line, which is the 9-day moving average. The blue line is 12 minus 26. And the argument here is, look, when the blue line goes below the yellow line, then it is theoretically a sell signal. And when the blue line goes above the yellow line, it is a buy signal. And I don't know that stocks are giving signals. And I was like, I'm not sure I buy into this. And so I overlaid the MACD of Ouster on top of that. And what I wanted to see is, can I eyeball how the stock is performing when the MACD goes below the signal? And can I eyeball the opposite? And in MACD itself is touted as a great algorithm when you have these huge positive and negative movements. But here you can see that there is a lot of quiet. When things are quiet, meaning they call it range bound, MACD is not a good indicator. And so I thought, let me overlay it on the stock price and see what it says. And it made a little bit of a believer out of me. You can see that right around here, the blue line, which is the MACD line, goes below the signal line. And the next time it emerges is right around here. That sounds pretty good to me. I missed that in Ouster. Once again, right around here, which is when I bought Ouster, the blue line goes above the yellow line and it kind of rides along all the way up to here. And then it goes under and it picks up again. This is, I would say, a more informed way of my little Humpty Dumpty algorithm that I had come up with. And it's actually telling me right here to not hold on to this stock and dump it. And I did not know it. I held on to it much longer and took a bigger loss. And so I started researching, I wonder if it only works for one or two stocks, does it work for other stocks? Here is MU, Micron Technology. I don't want to go through every inflection point. Again, a pretty good indicator of when to buy and when to sell. Then I thought maybe it only works for tech stocks. And so I put it on top of Walmart. Yet again, it works. So here is the lesson that it kind of made me stop and rethink. This all works great if the stock has a lot of volatility. Here is Vici. Vici is a casino real estate investment trust. I do own that stock. And you can see that the activity on this is very low because the stock kind of has flatlined. It has moved up by a couple of percent, moved down by a couple of percent, not really a lot of, ups and downs. In that scenario, MACD is a poor indicator or not as good an indicator of buy and sell. And so I started understanding what can I do to have a better signal. I've created my own algorithms. I don't want to share them yet, but here are the limitations of MACD. The first is it ignores debt to equity ratios. It ignores price to cash flow. So you do need to use fundamentals. At least I use fundamentals. I don't buy a stock just because MACD is above signal. I'm not a day trader, as I told you. The second thing is when a stock is range bound, MACD is not good. You need a way to filter the noise from the signal. The third is if you own 100 stocks, what are you going to do? Wake up in the morning and check MACD and signal and range bound for every stock? It'll take you all day. It takes me all day. And so there needs to be some kind of automation. So I am working with a tech person to figure out how to automate this. And I am trying to go from yield nerd to algo nerd. And I will share more as I proceed. And I'm trying to create an algorithm that can be run, that will then execute and create buy and sell signals with a lot more conservative approach and also detect range bound mechanisms. Now, I've been manually doing this for my portfolio of stocks, and Schwab said, dude, you are taking way more risk than even the most aggressive trading scheme, except I am absolutely demolishing the return. And so for 4% of my portfolio, my algorithm, which is now built on MACD with a little bit of change, has produced huge dividends. And I'm trying to see if I can automate that algorithm so I can run it on more stocks and increase my investment from 4% to something more than 4%. But hey, I certainly am able to smash NASDAQ and then some, almost double the returns of NASDAQ. And as I automated more, I will share how I'm doing it. So what are my holdings? The one thing that this MACD scenario did to me is it has encouraged me to trade more, because when I get buy signals, I buy, but when I get sell signals, I've been religious about selling. And as you can see, because I follow the upward trajectory of the MACD curve, I accumulate profits, but the profits are not very high. They go up and down. And so I do have several stocks that are on a solid upward trajectory and they accumulate a lot of wins. I have stop limits to make sure that I don't hold on to them past the inflection point. And so all of this later, I have a MACD informed algorithm that is making my day in equities. On fixed income, I have a muni bond informed allocation strategy that is going vertical. So all in all, good times are here at the Yield Nerd world. That doesn't mean it is going to last, and I'm constantly learning, and I would look forward to learning from you as well. Hey, even a broken clock could be right 2 times a day. Don't trust me. Do your own research, and thank you for watching Yield Nerd.